We're apparently reaching peak desperation in the AI bubble. Yesterday, Sam Altman of OpenAI announced that ChatGPT would soon allow adults to generate erotica and access more emotionally responsive companion style interactions. And he framed this as treating adults like adults. This follows closely after the launch of Sora, which is their text to video generator. Sora does not solve a defined user problem, and it lacks a clear path to profitability beyond subscriptions or advertising. And Altman's tone on advertising used to be derisive, and he called ads corrosive to innovation. And now he's done a complete 180, saying sometimes ads don't suck. And internal projections also show that OpenAI has projected ad enabled products to be launched in 2026, with ad revenue to form a significant part of its earnings going forward. This is the same company that glibly bragged about birthing technology that would revolutionize entire industries and replace millions of human workers. And now they're pivoting to adult content and ad driven products. This is desperation, and it's not just revealed in these products, it's in OpenAI's hiring patterns and across the industry at large. Adult entertainment and advertising are the two largest cash generators online, but they're also where tech companies go when higher value strategies fail. When a company promised to transform the global economy and they suddenly start targeting corn and ad impressions, that tells you something about their core technology's performance. These aren't premium markets, they're accessible, high volume, and low margin fallbacks. If you look at the trajectory, Sora is a creative tool with no clear professional monetization model. The companion features are going to focus on emotional simulation rather than professional utility. Adult content targets one of the internet's most reliable revenue streams, and the advertising openness represents a complete reversal of previous principles. Each step is a downgrade in ambition. You're watching a company move from we're going to revolutionize work and cognition to we'll monetize parasocial attachment and simulated intimacy. That's not what real confidence looks like. When we look at their hiring patterns, OpenAI currently has nearly 400 open positions. There are dozens of roles tied to massive data center projects that are burning cash despite widespread industry warnings about overcapacity and thin margins. At the same time, they're hiring account directors, solutions architects, and government outreach roles, both internationally and in Washington, D.C. This classic late stage behavior, when consumer growth plateaus, pivot hard to custom enterprise solutions and government contracts. Here's the problem. OpenAI is simultaneously trying to downregulate our ethical safeguards, massively inflate infrastructure capacity, and industrialize short term monetization. This triangle is only sustainable if exponential user growth follows, but we're not seeing evidence of that growth. We're seeing evidence of desperation because that growth is not materializing. Zooming out to the entire sector, because OpenAI isn't unique in this regard, the financial architecture supporting it looks disturbingly familiar. Here's what's happening based on recently announced deals. NVIDIA invests billions in OpenAI, and OpenAI spends billions buying NVIDIA chips. AMD grants OpenAI multi billion-dollar purchase rights and receives stock warrants. And this is like a coupon that allows AMD to buy OpenAI's stock at a particular price, no matter what the stock is trading at on the market. Microsoft finances OpenAI's cloud consumption, but books profits from OpenAI's Azure usage. See the pattern? Money circulates between the same players, creating the appearance of revenue and growth without producing external value. This does have the effect of boosting stock prices and valuations, however, and thus far that's kept things afloat. However, companies resort to circular structures when they're struggling. When a company's valuation depends on a growth narrative, but organic growth is stalling, circular transactions let you show revenue activity without needing actual new customers. You're essentially paying yourself. If you own stock in a partner company and that partner is buying your products with your own invested capital, you're artificially supporting both their revenue and your equity position. It's mutually assured inflation. These structures delay the day of reckoning. They let you maintain the appearance of functioning business models while you scramble to find actual product market fit. We've seen this kind of thing before. Enron used off book partnerships to hide debt and inflate profits, essentially trading with itself through special purpose entities and creating paper gains that had no underlying value. It worked until the confidence collapsed, and then the entire structure just imploded. And GE did something similar during its late phase, where they were moving money between divisions to paper over stagnation. So GE Capital would finance purchases from other business units, and that created revenue that looked like it was coming externally, but it was really just internal circulation. And when the credit markets tightened, the illusion just shattered. And I was at GE during this phase, and this strategy was called moving the whole. The AI sector now shows the same mechanical pattern, which is circular funding, inflated asset claims, and reclassification of internal transactions as external growth. And this is precarious because these arrangements this time around are looking legal. Nobody's hiding debt off balance sheets or cooking the books that we know of, but legality doesn't mean sustainability. This likely isn't fraud, it's that the entire sector is interdependent in a way that creates systemic fragility. When confidence breaks in one company, it's going to cascade through all the other partners. So what do the numbers actually say? Industry projections suggest that the infrastructure spending for AI could reach $7 trillion globally by 2030. That's data centers, chips, power systems, and the whole compute stack. Meanwhile, the actual AI product revenues globally are below $100 billion annually. Here's what that gap looks like. Even if AI revenues grow 50% year over year, which would be extraordinary, you're still nowhere close to justifying the infrastructure investment. No plausible adoption curve closes it in the relevant time frame. Every circular dollar flowing between these companies is a bet that exponential end user adoption will eventually materialize and retroactively justify today's spending. But we're several years into the AI boom now, and the killer apps just aren't emerging. The revenue that would validate these valuations isn't showing up. And meanwhile, the infrastructure keeps expanding as if it was. External conditions are piling on the pressure. Bond yields are rising, and every 100 basis point increase in yields magnifies the carrying cost of the data center debt. That directly reduces the available capital for research and development and marketing. Analysts are now forecasting that unless AI revenues go parabolic by 2026, the sector hits what some call a death cross, a debt overhang crisis where financing costs are going to exceed the realistic revenue projections. This macro context explains OpenAI's sudden pivot to controversial revenue streams. When your debt cost just tripled and your growth projections aren't materializing, anything that generates immediate cash flow becomes attractive, even if it contradicts your stated mission or damages your institutional credibility. OpenAI's adult content announcement and its Sora launch are canaries in the coal mine because of what these product decisions reveal about the company's strategic position. When the company that promised to build godlike intelligence starts optimizing for subscription retention through shoe ads and corn, you're watching the distance between narrative and reality become impossible to hide. The AI boom will likely still produce useful tools and real innovation, but the trillion-dollar valuations, the infrastructure build out, the circular capital flows, not to mention the 80% of stock market gains that the sector represents in the US economy, these are premised on a transformation that shows fewer signs of arriving with each passing quarter. OpenAI's desperation to find any monetization path tells us a lot about the viability of the entire AI economy. And given their very high profile desperation, I'd watch them first for any signs of collapse. If and when they go, the other big players are going to be dragged down with them.